An Investment Topic Guide. Chapter 1. Investment Topics 1. Aggressive stocks/high growth stocks/risky stocks/speculative stocks. I plugged the above terms into my favorite search engines for fun to see what would come out. You either have to have guts, have more money than you need, or be pretty stupid to buy high-risk stocks. Penny stocks are considered aggressive stocks because any stock under $5 either hasn't proven itself yet or was once good but fell way down. Aggressive investing means you are willing to accept above-average risk in the hope of above-average returns. Risktolerance.com 247wallst.com aggressivestocks.com winninginvesting.com winninginvesting.com/high_risk_stocks.htm Anti-tech stocks info. Because of the general volatility of tech stocks for any of a number of reasons, like the research fails, the product becomes obsolete, oversupply of the product, increased competition, lawsuits, etc., some very successful investors stay away from them and do quite well with basic bread and butter stocks like money stocks, banks, brokerages, basic retail like Walmart and Home Depot, utilities, and a few other well-chosen basic product stocks. Buybacks info. If a company offers to buy back some of its shares from the public, it's supposedly a good sign that the value will rise, and investors often use it as a sign to buy, thus driving the price up for the short term, but it could be just a psychological ploy just to try to get some hype for the company. The results indicate that the motivation behind a buyback doesn't matter, the stock value usually ends up ahead, but be wary anyway. The website onlineinvestor.com as well as others track buybacks daily. Beneath the surface, the company often borrows the money to do the buyback, so they have to pay interest on it, which thus offsets any gains they may have made by not having to pay out dividends on the stock anymore. One guy tracked a large number of buyback stocks over a 2-year period and found their overall gains were about the same as the S&P 500 index, so the point is that before you jump on a buyback, investigate the company further. It's likely just an average, cosmetic move. A truly great company invests in the real long-term growth of production by expanding, not in the cheap ploy of a buyback. Cash management accounts. A cash management account is an account with a major brokerage which takes care of everything from checking services to debit card to money market fund to trading stocks. They usually have a high minimum balance and an annual fee. Some stock brokerage firms also offer this service on their asset management accounts. As long as you keep $5,000 minimum in the account, you can write checks on it and enjoy a 5% plus interest rate. Charles Schwab. 800-421-4488. Schwab.com. Fidelity. Ultra Service Account. 800-544-6262. Fidelity.com. First Union. 800-720-9339. FirstUnion.com. Unified Management Corp. Unisave Account. 800-862-7283. White, Jack. 9191 Town Center Drive. 2nd FL. SD California 92122. 888-414-2500. jackwhitco.com. No annual fee. Contrarian investing info. Buy when everyone else is selling and hold until everyone else is buying. This is not merely a catchy slogan. It is the very essence of successful investment. J.P. Getty. Don't listen to the hype. Listen to your own sound research. The spirit of contrarian investing is to break from the herd and have the guts to do what you think is right even though no one else is doing it. When you follow the crowd, the best you can do is get the same results. When you follow yourself, you could gain big or lose big, but at the end of the day, you will never be accused of being one of the timid ones in the crowd. You will be an original, following your own path in the arena of life and investing. Contrarian investing is to look for what's out of favor now, but in your opinion and intuition will be back in favor at some point in time. You invest in what others wouldn't dare invest in, but you believe in it. Contrarian investing as a philosophy purports that favored stocks don't gain much because of the sheeple bandwagon effect, so they're counterintuitive. Whatever the masses are doing in the market, do the opposite. They look for either good, unknown stocks or stocks of good, solid companies that are currently left for dead by the mainstream but have the potential to bounce back big. The underlying rationale is that investors are way too emotional, overvaluing favored stocks and undervaluing unfavored stocks. The market operates on hype, not on good sense. The contrarian simply looks for stocks with a firm foundation and tries to buy them before the masses are swayed by media hype and get on the bandwagon. You're not all rational. You realize that part of a stock's price is based on hype, so you're looking for a middle ground stock, a good stock with a firm foundation that has not yet been hyped all to crap but could be. Then you buy, wait, and if it gets hyped up, you sell right in the midst of the hype, because all massively hyped stocks go down in price. You don't have to take risks. Just go the extra mile in doing sound research of stocks the mainstream media heads are not hyping lately. When you see a stock that's bringing in money, expanding, the share price is rising, it has a track record of success and is in a stable industry that won't all of a sudden get wiped out by new technology, by all means, have the guts to buy it even though nobody else is. You break all the rules, even the rules that say buy and hold, buy index funds or diversify. You do what you feel is right. Some guy said when you're looking for a good stock, all you're looking for is a stock with a real foundation that has been doing all right and you expect it to keep on doing all right. That's how simple it is. Find a solid company that has been having good returns based on real production as opposed to hype, buy it and watch it for a while to see how it goes. Contrarian is all about the comeback stock, like Toys R Us a number of years ago, beaten up, left for dead, then it bounced back. Look for good companies that have been around a while, longer than 5 years, and got beat up in the past year for one reason or another such that the share price is way down. Study them, then make a decision on the ones that look undervalued. By the same token, before you sell, if you're in a panic when you see the price drop, slow down, examine the price drop and analyze it before you sell, because you're worried about a quick, dramatic loss. InvestmentContrarians.com, ContrarianProfits.com, ContrarianInvesting.com, ContraryInvestorsCafe.com, The Contrary Investors Cafe, Contrarian.ca, InvestingContrarian.com, ContrarianInvesting.com. Corporate accountability websites. Corporate accountability groups are movements made up of either angry or socially conscious people geared to watch the greediness and inequities of corporations. CII.org, CorpGov.net, erators.com, ISS.cda.com, lens-inc.com, paywatch.org, ragem.com, sec.gov, stakeholderalliance.org. Derivatives info. Derivatives are investment schemes or investment packages that the people at investment firms create to offer another investing option to investors. Since they are partially blamed for the economic downturn in society, I doubt that they're around much, but I could be wrong. Basically, some investment company holds bonds, stocks, mortgages, etc. All these things promise X amount of money at some point in the future. It's supposedly guaranteed money, but it's not if the people owing money on these instruments/deeds default, as in a big default of mortgages which caused an economic downturn. That's beside the point right now. The point is that the investment managers package these derivatives, then sell them for a discount price. They get money right now. The derivative buyer supposedly gets a big payoff at some point in the future. Here's a passage about derivatives from survivalblog.com. In a perfect world, derivatives are a nicely balanced mechanism, where there are parties and counterparties, and every derivatives contract equation balances out to have a neat zero at its conclusion. But we don't live in a perfect world. Companies go bankrupt. Contracts get breached. Counterparties disappear and disappoint. We have not ever experienced a derivatives full-scale blow-up, but I predict that when it happens, it will be spectacular. The scale of derivatives trading is monumental, and the vast majority of the population is blissfully ignorant of both its scale and the implications of a derivatives crisis. There are presently about $500 trillion of derivatives contracts in play. That is many times the size of the gross product of the global economy, but the average man on He Street has no idea what is going on. It won't be until after the giant derivatives casino implodes that the generally dumb public GDP awakens and asks, what the heck happened? Analytx.com, Securities Derivative Info. Survivalblog.com/derivatives.html. Derivativesmodels.com, free online financial derivatives models. Numa.com, derivatives. cdef.com, fixed income derivative brokers. Direct public offerings info. DPOs are companies which don't get a brokerage to underwrite them and sell their shares directly to the public, as is common with all companies valued under $1 million. dsm.com. med-man.com, does DPOs. Dividend stocks info. Dividend stocks generally make good sense because they pay out dividends, which are usually quarterly payments to the shareholders as their share of the profits. This is an extra payment over and above the fact that the stock will probably rise in price and the stockholder will make money there. The other thing is that by virtue of the fact that the company pays out a regular dividend, which not many do, is a positive sign, because generally only good, prosperous companies are in a position to offer dividends, although there are exceptions. Look for good stocks that pay dividends. They are almost certainly winners. mdi.morningstar.com. DividendDetective.com. Dow Industrials Investing. The Dow Jones Index is an index of about 70 stocks in 4 different sectors that are considered the major stocks in America. Of these 4 sectors, the Dow Jones Industrials Index is considered the most prestigious. This is the index they report on the news every night. These 30 stocks are the representative gauge of the entire economy. This list of 30 stocks doesn't stay constant. Some stocks get kicked off while companies doing really well are invited in. As an investor, you can pick any combination of analyses, but the crux of Dow Jones Industrials investing is that you limit your investing to these 30 companies. Pick what you consider to be the top few companies in this list to invest in. Some people say pick the newest entries in the index. Some people say pick the companies who have had the highest gains in the past year, which is easily evident by looking at graphs of all of them together, which I've seen in the Value Line Investment Survey and in Investors Business Daily, and from that, pick the ones that you perceive to be the best. Still another theory is called the dogs of the Dow theory. The assumption is that all these companies in the index have a proven track record of doing things right, but some of them aren't doing so hot right now. You pick the ones that are down the most from their 52-week high because you believe they have the most to gain. They will turn around and recover because these companies usually do. Dogsofthedow.com. Earnings estimates. Earning estimates is a concept you hear on the news all the time as to why the stock market rose or fell today. A few of the big companies can influence market swings. They make quarterly projections as to what they will earn, which is broken down to a per share amount of money, which is expressed as X cents per share. Analysts do this too. If they meet this projection or better it, everybody is happy and the stock goes up. If they don't meet it, the stock goes down. I saw a funny one with Apple. They were doing great. They had sold 6 million iPods and introduced the video iPod, but they didn't quite meet expected earnings, so the stock went down for a few days, then went back up. I thought it was really. One day, the newspaper headline was something: Apple doesn't meet earnings expectations, markets go down. The next day they were praising Apple as a stellar company. Briefing.com. Firstcall.com. Energy investments/energy stocks. If you want a roller coaster ride, invest in energy, both mutual funds or stocks. First off, all speculator companies who look for oil and/or other energy or precious metals are always a risk, and they could be an outright scam company. It has happened many times before. Secondly, when the Soviet Union went free, all those little satellite countries got on the bandwagon, and now they're selling oil and any other metal or raw product that they got, so it's a flooded, Glutted market. Advances in technology have made oil drilling much cheaper, hence increased competition as all manner of speculator goes out there to find oil, plus the fact that every third world country is inviting these guys in to exploit the hell out of them. I decided I will stay out of energy for the rest of my life. What if somebody comes up with some fantastic alternative energy source? It will happen, and then you will lose everything as oil becomes an archaic concept. API.org, American Petroleum Institute. Enertechcapital.com. IHSenergy.com. Gasprocessors.com. Litlardbook.com. EnergyTechStocks.com. OilOnline.com. Pengrowth.com. Texaco.com. Fringe benefit stocks. Though it may sound like a trivial reason for buying stocks, some companies offer fringe benefits to their shareholders for owning their stock, like discount coupons for purchasing their products. Others offer food and products usually handed out at the annual shareholder meetings. For more information, buy the book, The 100 Best Stocks to Own in America, Dearborn.com. Some of the companies that offer fringe benefits to shareholders are 3M, free gift package of tape, post-it notes, etc. American Recreation Centers, coupons for free bowling. Anheuser-Busch, discounts to their amusement parks. Brown-Forman, discount on products. Calone Wine, wine discounts. CML, discounts of Nordic track equipment. Colgate-Palmolive, discount coupons. CSX, discount for stay at Resort Greenbrier in White Sulphur Springs, WY. Disney, discounts on theme parks and merchandise if you join the Gold Card program. General Mills, holiday package, get $50 worth of stuff for $20. Hershey Foods Corp. Kellogg, Quaker Oats. Kimberly-Clark, Christmas goodie bag cheap. Marriott, hotel discounts. Moto Photo, club membership. Ralston Purina, free or discount tickets to company-owned ski resort. Santa Anita Corp., free admission to horse track. Scott Paper, Christmas goodie bag cheap. Supercuts, coupons for haircuts. Tandy, discount at Radio Shack during holidays. Tonga Capital, free beef. Walmart. Walt Disney offers discounts to shareholders on its Magic Kingdom card. Wrigley, free gum, 10 packs a year sent to you. The hedging technique info. Hedging means spreading out risk in your investments. It means you diversify. You don't just invest in 1 or 2 stocks or mutual funds. You invest in at least 6 or more. In futures trading, a soy farmer hedges his risk by buying soy futures so he has a guaranteed price regardless of what the real price is when he's ready to sell his crop. What this means in real life for you, is that if you buy oil stocks, you also buy stocks in other energy sectors like natural gas in case oil stocks go down. If you buy sugar stocks, you also buy corn stocks because corn syrup is a big substitute to sugar, so if sugar stocks go down, corn syrup will take up the slack and go higher. This technique is usually used by the big timers who have enough money to buy all kinds of stocks. If you buy a stock of company A who is the industry leader, you would also buy stocks of second place company B in that sector to hedge your bet in case company A's stock goes down for whatever reason. Initial public offerings/IPOs. When commissions were deregulated May 1, 1975, the brokerage houses lost their major source of income as commissions went way down. They had to look for another source of income. In the 80s, it was mergers and acquisitions, but in the 90s, with the internet producing new companies making incredible IPOs, Netscape.com, TheGlobe.com, Drugstore.com, Cashflow.com, Priceline.com, eBay.com, the underwriters were getting commissions of about 7%, so they went nuts, aggressively looking for anything that could pass for an IPO, even though many of these companies were barely more than a business plan with no assets, no track record and no proven performance. There were 4,700 IPOs in the 90s, then the bubble burst. They got their commissions regardless, while most of the public stock buyers lost a lot of money because of all the hype by these brokerage firms promoting what were obviously dummy companies with nothing going for them. The lesson is: be smart. IPOs are usually duds unless it's a private company that's been around a while and is just now going public. You probably can't get in on the first run of most IPOs anyway. The brokerages offer them to their institutional investor buddies first. They buy a bunch and either sell them later on in the first day of the IPO to make a handsome profit, or wait a day or two then sell once the IPO is all hyped up and selling to the public. This is called flipping, and it's very common. You can't beat the people on the inside. They're setting you up every time with their hyped up IPOs. All these insiders got their profits, so they don't care what happens when the IPO is dumped onto the public. I say stay away from IPOs unless you know for sure it's a proven company. Many new initial public offerings, IPOs, increase drastically in the first month but 40% decrease in value within the first year. Do your homework. Don't invest unless you can get in dirt cheap in the first week, then sell after the initial onslaught, or if you know for sure the company's going places. Check with the seconds to see if the underwriter has any complaints against him. In my opinion, IPOs are too risky to bother with unless you know something for sure. For the OTC market, most new issues are overpriced and will go down. Buy with the target of selling at any time at a profit. Check out the auditors and underwriters in the prospectuses of OTC stocks with the seconds to see if they have ever had complaints against them. Ask if they have plans to move into Nasdaq. If they do cross over, your stock will rise in value. Check the following newsletters for information about new offerings. If you want to get into IPOs, find an underwriting brokerage firm that handles IPOs, find a broker in there, become a good client with him, and then he might let you in on the primary sales phase of the IPO. By law, the brokerage firms are allowed to freely advertise their general services as brokers, but when it comes to an IPO, all that they're allowed to do is to place a brief ad in the financial on the day of the news called a tombstone, which is kind of ridiculous since by the time the average investor sees this IPO of a good company, all the shares have been long sold, which is why it's all about contacts when it comes to making money in stocks, or meticulous reading where you learn about IPOs in advance from journalists in the know. IPOs are frequently sold in two phases. A primary phase to institutional investors and good clients. A secondary phase to the general public. Don't buy new public offerings because they're probably overpriced and you have no background to judge them. Watch them for a few months to see what they do. The risks are too high that it could bust unless you know it's a good company. Most IPOs aren't worth it. Below are just some of the stringent requirements a company must adhere to in filling out a full disclosure statement when going public to become an IPO. 1. The name of the issuer. 2. The name of the state or sovereign power under which the issuer is organized. 3. The location of the issuer's principal office. 4. The names and addresses of the directors and other senior officials. 5. The names and addresses of the underwriters, if any. 6. The names and addresses of persons owning 10% or more of any class of issuer's stock. 7. The quantities of securities owned by the directors, senior officials, underwriters, and 10% or greater holders. 8. The general character of the issuer's business. 9. A statement of the issuer's capitalization. 10. A statement of securities reserved for options outstanding, with names and addresses of persons allotted 10% or more of these options. 11. The amount of capital stock of each class included in the offer. 12. The issuer's funded debt. 13. The purposes to which the proceeds of this offering will be applied. 14. Remuneration payable to the issuers directly, naming them specifically when annual payments exceed $25,000. 15. The estimated net proceeds to be derived from the offering. 16. The price at which the public offering will be attempted. 17. Commissions, fees and so on, to be paid to the underwriters. 18. An itemized detail of expenses incurred by the issuer in connection with this offering. 19. The net proceeds derived from any securities sold by the issuer in the preceding 2 years and pertinent details of those sales. 20. Any consideration paid to a promoter in the preceding 2 years. 21. The names and addresses of any vendor of property or goodwill to be acquired with the proceeds of this offering. 22. Full particulars of any dealings between the issuer and its officers, directors, and holders of 10% or more of its stock that transpired in the preceding 2 years. 23. The names and addresses of counsel passing upon the legality of the issue. 24. The dates and details of material contracts created outside the issuer's ordinary course of business within the preceding 2 years. 25. Certified financial statements of any issuer or business to be acquired with proceeds of this offering. 26. A copy of the underwriting contract or agreement. 27. A copy of the law firm's written opinion attesting to the legality of the issue. 28. A copy of all material contracts referred to in item 24. 29. A copy of the issuer's charter, bylaws, trust agreement, partnership agreement, and so forth, as the case may be. 30. A copy of the underlying agreement or indenture affecting any security offered or to be offered by the issuer. business.com/directory/investment_banking_sales_and/sales_brokerage/sales_and/trading/equities/initial_offerings_IPO. epub.com. alertipo.com. directipo.com. ipocentral.com. ipodata.com. epom.com. iposyndicate.com. ipoexchange.com. ipoinsight.com. ipomonitor.com. ipo-network.com. ipomaven.com. ipodirect.com. standardpoor.com. Chapter 2. Investment Topics 2. Insider Disclosure Form 4s. An insider, as defined by the SEC, are company executives, directors, or any shareholder with 10% or more of a company stock. Whenever an insider buys or sells some of his own stock, he or she must legally fill out Form 4s and give it to the SEC by the 10th of the month after the transaction. This information is then freely available to the public for scrutiny, but the SEC's own compiling of this information in their official summary of security transactions and holdings is dated because it comes out monthly. After this information is really useful, but there are internet newsletters and websites that hang around the public disclosure room of the SEC building at 450 5th St. Northwest in Washington and American Samoa. Soon as these forms are filed, they analyze it and get it right on their internet. Some people use this information as their criteria to pick stocks, even though other critics say it's not very good. Overall, if insiders buy, that's a more reliable predictor that the stock might go up than if they sell. They sell for a number of reasons, but buy only because they think the stock will go up. The bigger the buy in terms of number of shares and number of insiders buying, the more likely it will go up. Institutional investors and the accumulation/distribution rating. Institutional investors are big players like mutual fund companies, company pension funds, government pension funds, government finance offices, insurance companies. You'd think that they know what's going on since they're risking millions to billions of dollars. The accumulation/distribution rating scale rates stocks based on how these big investors are buying or selling it on a scale from A to E. A means they're buying lots of it. E means they're selling. If you follow their lead, you'll buy stocks that have an ORB rating. You can find this accumulation/distribution rating scale at investors.com, which is the website of the newspaper Investors Business Daily, or find it on other major stock websites. Investors Business Daily. 12655, Beatrice St. Law, California, 90066. 800-453-4840. 800-243-0698. Investors.com. Irrational exuberance. Irrational exuberance is the catch term used to describe a stock market gone crazy with hype, overinflated stocks, optimism that the market will keep going higher and everybody in it will get rich. This brings a lot more investors into the market and then it crashes. The last time this frenzy happened during the internet boom, the market followed this predictable script. The lesson is don't listen to the hype. Listen to yourself. Study companies one by one. Pick companies with at least several years track record doing well. Don't just go along with the tech sector on the latest new thing. The best time to actually make money is during a bear because the risks are lower. When the stock market is going crazy on unbridled enthusiasm, withdraw all your money, wait until it crashes, then buy up some good quality stocks that seem to look bad for the moment. The key term is speculation. When people start betting big that the latest new thing will make lots of money even if it has no proven track record, watch out. What happens in these cases is two things. The stocks get overvalued very quickly based on no tangible brick-and-mortar property nor a solid sales record. A bunch of companies get in on the action, causing an oversupply of this big thing, whatever it is, like the cell phone revolution. The bubble will burst. When everybody is into the hype, look around for good companies with a good track record that don't seem popular at the moment. If foreign stock markets dip, watch for a domino effect. Try number 332.632 at the library for current books about the state of the stock market. Major difference between stocks and funds. A good stock is a good company. It goes on a run, has its heyday and stabilizes. That's when you sell it. A good mutual fund is a network of a bunch of stocks which are constantly being changed by the managers. It's much more susceptible to the forces of the market as a whole than are good stocks. When the stock market burns as a whole, every mutual fund drops, but if you have a few good stocks, they could keep going despite the bear. Although I started out as an investor by investing in funds, I have since learned that you're better off finding a few good stocks and sticking with them. You pay out too much in fees on funds anyway, and the gains are generally paltry next to a good stock. Plus, when the stock market burns as a whole, all mutual funds lose while there are good stocks that always keep gaining. When the market recovers, the big stocks usually bounce back to old levels, but a bunch of little stocks get left behind, stuck with their losses. That's the way it works, so your mutual funds will not parallel the recovery in the Dow Jones Industrials. Find a few great stocks and stick with them, and bypass funds altogether, or start out in funds then move into stocks. I started out thinking I was safe in funds because they're diversified, but the thing is, if you find the 5 greatest stocks out there, which really isn't that hard because there are plenty of top performing lists out there, chances are that you will make a hell of a lot more money than you will if your money is in a fund. Funds are really not as safe as doing your homework, finding a few good stocks and going with them. If the market is going down, you might consider transferring your no-load funds to a money market fund within the same company. Granted, all investments are risks. Many oodles of people play it safe by putting their money into mutual funds because they think that if a few of the stocks in the fund fail, it will be offset by the diversity. Granted, a great stock could fail at any time, and if you invested in it, you'd lose big. If you want great gains, you got to assume this risk by investing in stocks as opposed to funds, the risk of possibly losing all. If the market drops, all mutual funds will drop, which is why I don't like them, but good companies stay strong, so that's where I stay. Mutual funds are wimp investments next to stocks. Margin buying/buying stock on credit. When you buy a house, you get a mortgage loan. Margin trading is getting a loan to buy stocks. Before trading on margin, you have to meet margin requirements set by the Investment Dealers Association. Margin trading, also called a margin fund, is money the brokerage lends to some investors which they use to trade with. Brokerages do it because they make money from the commissions on trades as well as charging interest on the money. If you lose money on the stocks you bought through the margin loan, you're responsible to pay for it out of your own pocket. There are stringent rules set up by the SEC. There are rules called the initial marginal requirement, which say that the brokerage can only lend you an amount equal to what you have in your brokerage account, no more than that. Mergers and acquisitions. A merger is a situation where the managers from several corporations decide to unite under one entity, like with Pepsi, Kentucky Fried Chicken and a few others. These managers aren't fools, they're doing it to make money, so when you hear about a spin-off, buy into it. Mergers are risky for many reasons, like they can fall through or not perform up to expectations. Wait until the merger is completed, watch for a while then act. Companies try to acquire other companies all the time, mainly for growth and some to trash them in the corporate raider sense to make quick money. Mergers are more a partnership, two companies unite to become one, often keeping top management from both of them. Hostile takeovers are a situation where a company tries to acquire shares of another company to get a majority ownership, 51%, to have the power to make all the decisions. In general, M&As are complicated legal and business affairs. Once two companies reach an initial preliminary agreement, the process moves into the legal and business due diligence phase, where both companies examine the other's documents, production, etc. in order to determine whether everything is solid enough to justify closing the transaction. It's like a court case where both sides open their files to each other so they can examine them. In a merger, both companies examine one another. In an acquisition, the acquirer examines the other under a microscope. It's quite tedious. Your lawyer, an accountant, will handle most of it. After the due diligence process, an offer is made, they haggle with each other and either reach what is generally a complex agreement or the deal is off. A leveraged buyout, LBO, is simply a situation where a person with a good credit record finds a business he wants to buy, then goes to lenders like banks, finance companies, etc. and works out a deal where he gets a loan to buy the business using the business as collateral for the loan. The lenders generally lend 75% of the business cost and want the guy to put up 25% of his own money. If you've got savvy, you might be able to pull it off. W.T. Grimm & Co., 135 South LaSalle St. Chicago, Illinois 60603 publish an annual report on mergers and acquisitions as well as offering consulting services to buyers and sellers. Beard.com, Asian Mergers and Acquisitions. MareReport.com. MergerNetwork.com. MergersTat.com. ThirdGroupInc.com, Mergers and Acquisitions. Mergers and Acquisitions websites. mergeregist.com, wtgrim.com, Annual Book. IBBA.org, International Business Brokers Association. Acquisitions.aboutinvesting.org. ACQUISITIONS-MERGERS.com. ACQUISITIONS-MONTHLY.com. Mergers.com. Mergersacquisitions.com. MergerNetwork.com. Mergersbusiness.com. MERGERS-ACQUISITIONS.com. MergerWizard.com. Numbers game. GM is not in the business of making cars. GM is in the business of making money. Thomas Murphy, ex-chairman of GM. I don't analyze stocks much in terms of numbers, so for more information in this area, I refer you to the number 332 section of the library. The price/earnings ratio, P/E, is an indicator of a stock's value. It is simply the price of the stock over its earnings for the past 4 quarters per share, how much money the company earned. The smaller the ratio, supposedly the better the deal for you to buy as a bargain, because it supposedly means you're getting the stock cheap in relation to others, and when earnings recover, the price of the stock will follow. When the PE is high, some investors generally think that this means that the stock is overvalued and will lose in the long run. The savvy investors say all the dummies blindly erroneously use this as an indicator because it's become ingrained in the conventional wisdom of the markets. It's not necessarily so. The lower the PE, the lower are investors' expectations of that company. The higher the PE, supposedly the higher the profit potential, and people are willing to pay more per dollar of earnings. Although I don't buy this as the universal rule, the general consensus is that stocks with low Ps do a lot better than stocks with high Ps, because high PE stocks are overrated and generally don't pan out in the long run. You can compare the Ps of several companies in a particular field and use this as your final criteria before deciding to buy stocks that are close in overall performance, but other than that, don't just go in there and blindly buy stocks with low Ps. P/E ratio is something like the ego of the company. If it's high, it means investors like it and it's doing great, but it could also mean that it's overvalued, worth more than it's really worth, so there is a risk that it could drop. Refer to significant earning growth over the years. The P/E ratio always looks too high for most people to buy. Good stocks' P/E ratio start at 20 and go to 45 within 18 months. If it's low, it means it's not doing so hot. Sometimes, you can find gems in companies with very low P's if they have good management and turn it around. These are called value stocks. Case in point, IBM, which lost out from its mainframe business when PCs became popular, but new management moved in and they turned it around. The real indicator of stock value is the current earnings per share. Check to see how much it's up per quarter. 25% is good. If the annual earnings per share is up by 25 to 50% per year, that's a good sign. Hence, the real indicator is percentage increase in earnings per share. Many of these are in the Nasdaq market. Dividends, book value, or the P/E ratio are not the real indicators. Look at the earnings per share. Be wary of a high percentage increase in earnings per share. It may be a corporate raider doing some fancy manipulation to hype up the stock for the short run. Stocks with dramatic increases in earnings per share usually fizzle quickly, so if you buy, watch for the fizzle then get out. Refer to the related section. The dividend yield tells you how much the company is paying out in dividends, therefore, how much profit it's making. It is the ratio of the annual dividend per share over the annual earnings per share. Obviously, the higher the better. One expert says to make a list of the companies you want to invest in, make a list of their dividend yields and pick the highest ones. If the annual dividend yield is higher than 7%, meaning the company is earning a profit of 7% per year, not to mention its growth, it's a good stock. If you get good dividends on a stock, it usually means it's profitable, especially if it's a large company, but it shouldn't be a major criteria. The price-to-book ratio, book value, is derived by dividing the current price of the stock by its book value. Like the P/E, the higher the book value, the worse the stock does in the long run. However, these are usually growth stocks, so if you see a good deal, don't let a high book value stop you from buying it. Price to book value is the current stock price over the book value per share. Book value is everything the company owns, including real estate, buildings, inventory, etc., minus everything it owes, asset minus liabilities, then divided by the number of shares to come up with book value per share. Some companies sell due to their book value because investors think they're good companies with potential, while others think they're getting a bargain when a company sells for less than its book value. The lower the price, book ratio, the better. Look for stocks selling at a price no higher than 1.3 times book value per share. Return on equity is the company's net profits after taxes divided by total shareholders' equity. High return on equity indicates a growth stock. Look for a return on equity that is consistently high compared with other companies in the same industry, or that shows a strong pattern of growth. A steady return of 15% or greater shows that the company is managing itself well. Debt-equity ratio is the debt the company has in relation to shareholders' equity. The lower the better, with 35 or less a good indicator of a solid company. Beta is the term used to describe how much a stock moves in relation to the stock market as a whole. A beta of 2 means it changes doubly when the stock market changes. Stick with betas of around 1, which means that the stock mirrors the fluctuations in the stock market. If the reported earnings growth slows down significantly, that's bad news. Climax top is when a stock advances strongly for months, then suddenly for 8 to 10 days it increases in price breadth larger than before. It's a sign to sell. If several real leaders in an industry group top out, this will likely spread to others in the same group, so it's time to sell. As for the number of shares outstanding in corporation capitalization, the smaller number of shares outstanding the better. Look at the general market indicators in the Investor's Business Daily. Common sense says go with hot, high-demand stocks, but beware of hype at the same time. If the CEO of the company is on the cover of an investment magazine and everybody's talking about it, it's time to get out because it's become too obvious. Other factors are little or no debt, high profit margin, and watch out if competitors start to emerge. Re-evaluate your stock every 6 months or so. Look for companies in specialty fields with little or no competition and industry leaders. Over-the-counter/OTC stocks. Like the stock exchanges, the National Association of Securities Dealer Automated Quotation/NASDAQ also buys and sells securities, but electronically, not on a physical floor. They have some qualifying standards before allowing companies to be listed on their exchange. Beyond that are several over-the-counter, OTC, bulletin boards where company shares are traded without needing to meet any standards. Obviously, these companies are the riskiest to invest in. The OTCBB is an American electronic quotation system that displays real-time quotes, sale prices and trading information for microcap stocks. Companies listed on the OTCBB must file financial reports with the United States Securities and Exchange Commission (SEC), sec.gov. The pink sheets are listings of price quotes for companies that trade in the OTC market. They are not regulated by the SEC. Over-the-counter, OTC, stocks are traded through a vast network of corporations, brokers, and financial companies. There is no one place where these stocks are sold or common characteristics that define them. The most popular several thousand OTC stocks are listed with NASDAQ. There are many others not listed on NASDAQ that are sold through various means by various broker and companies. The OTC has no restrictions. There are over 20,000 stocks listed on the over-the-counter bulletin board/OTCBB, most high risk, low cost. Some others are Boston Stock Exchange, BSE, Honolulu Stock Exchange, Intermountain Stock Exchange, SLC, UT, Midwest Stock Exchange, Chicago, Pacific Stock Exchange, LA, SF, Spokane Stock Exchange, Toronto Stock Exchange, FSET, Canadian Dealing Network, CDN, Montreal Stock Exchange, ME, Alberta Stock Exchange, ASE, Vancouver Stock Exchange, VSE. OTC stocks from any company are usually sold by one particular brokerage company. Brokers charge a commission fee when selling a stock to an investor. At the library, Moody's publishes OTC Industrials. The best book I found to learn about OTC stocks is Walker's Manual of Unlisted Stocks, 3650 MT Diablo Boulevard, number 240, Lafayette, California 94549-9957. One guy belongs to an online database of 9,000 plus companies. He has programmed his computer to eliminate all companies with high Ps, more than 20,000 employees, high debt, and from the list he gets back, he focuses only on smaller companies with a $50 to $500 million capital value. With this list, he does more research to find the best ones. This is how he got rich, by finding one good stock a month and investing in it. I'm on a mailing list where I get a card deck every month or so which lists about 50 or so OTC stocks. I stay away from gold, oil, and generally food because it's so competitive, although there are some successes. I send for several annual reports, read them over and may buy a few solid OTC-looking stocks. Your best bet to check out an OTC stock is to see who owns shares in it in S&P's stock guide and make sure they have got at least 500,000 stocks as well working capital to back it up. Make sure they have been in business for a while, the longer the better. The secret to making it big on Wall Street is to find the gems in the rough that the so-called experts haven't found out about yet, that aren't plastered all over the money magazines and other media. The challenge is to do current research on good companies, particularly newer ones in the OTC market that hardly anyone has heard of yet. The only ways beyond networking, which I don't trust anyway, are to buy current books, current magazines, and newsletters, read the financial dailies, watch the financial networks and check out the internet. If you see a company you're interested in, write to them and ask for their annual and quarterly reports. If you invest in a few of these companies that take off, you can easily double your investment in 1 to 2 years. It happens all the time. You just have to pay the price by doing good research in obscure places. Send the companies a letter and ask them for a copy of their annual report and their 10K supplemental report. Get the address from corporate websites or at the library at number 338.00-338.776, Corporations. Beware of investment fraud in OTC stocks. Shady dealers create these stocks out of thin air, hype them up with press releases and crap on the internet. A lot of suckers buy, they cash in and are gone when it crashes. To protect yourself, always check to see if the company is listed on the SEC's website edgaronline.com or sec.gov with real audited financial statements. Then, at least you will know it's a real company. If any OTC company goes up way too fast as the result of hype, don't buy it. If an OTC company seems to have too much good publicity, it's probably the company itself pulling the strings. Beware that some of these websites hype up worthless stocks. OTCStockExchange.com, mbtrading.com, OTC Stocks, microstocks.com, OTCBB.com, OTCDayTrading.com, pennystock.com, smallcapcenter.com, penny stocks info. So-called penny stocks, basically upstart OTC stocks, represent small, emerging companies with a net worth of less than $5 million. They have a bad rap because they're considered a risk, and if there's a scam around, you will find it here. It's tough to find a winner in any bunch, including penny stocks. The reports are always hyped up. They're all speculative, unproven companies, and nobody even wants to broker them because the commissions are so low, although some con artists like to peddle them because it's very easy to say they have a company about to bust loose with a new product or service or expand worldwide. They like to say get on the ground floor now with urgency and compare their company to Microsoft or some other giant that took off. I have read at least a dozen reports on penny stocks, and everybody not in the business says stay away from them. My advice is to check out an educated person's newsletter like the Bowser Report and cautiously experiment with his advice. Penny stocks are generally low-quality stocks without much capital nor proven track record. They're the slot machines of the stock market, a cheap investment that might hit big but more than likely won't. If you see a penny stock you like, watch it to see if it rises more than $5 in a year. If it does, consider it. If it doesn't, forget it. If you study them and pick a winner, you could make a lot of money. One indicator is a new type of product or product line. If it's competing with others in a certain industry, it could get eaten up. Beware that new companies often fold for simple reasons like they just don't have enough money to keep them going until they hit. A penny stock is just like any other stock except that its value is in pennies. Penny stocks are often created in a different way than full registration stocks, with less stringent requirements. The prospectus details the direction the company wants to go and should detail the risks. Often the company has no financial assets, just a plan of action with little or no operating history, so beware that many penny stocks are speculative in nature. You as the investor provide the money. They do the work. You could both make a lot of money or the company could go bust. There are two types of brokerage firms, ones that just sell other people's stocks and ones that trade stocks for underwriting firms or underwrite many stocks themselves, including penny stocks. Look in the phone book under either brokerage firms or stock brokers and find brokers that deal in penny stocks. Penny stocks are also called venture stocks because the concept is something like the old days of prospecting, looking for the big score diamond in the rough. Do your research as with anything else. The Denver, Intermountain, and Vancouver stock exchanges deal heavily with penny stocks. Get their newspapers and go from there. Many of these stocks aren't even listed on the exchanges. You find them either through a good broker and a good newsletter. Certain brokerages deal with OTC stocks exclusively. You have to find them and make a deal for the stocks. OTC stocks generally have two prices in the tables. OTC bid, which is what the market will pay if you sell. OTC ask, which is what they're selling for. They always sell for higher than they will pay for them. That's the profit for the brokerage who holds the stock because they're taking a risk by buying them and holding them to sell. The spread is the difference between the two. Generally, the hotter the stock, the lower the spread because they can make their money on high-volume sales. Although there might be some good deals there, penny stocks are where all the duds are too. Beware of dummy companies formed by scammers. Scammers know how to play you by selling you a stock then making it rise for a while so that you get suckered into more before it drops. If someone tries to pressure a stock onto you, don't buy. Pick them yourself and make your own decisions. One expert says to buy 100 shares of several or 30 to 40 different penny stocks and expect the winners to outdo your losers. Try the following books at the library. Dun & Bradstreet $1 Million Directory. National Stock Summary. Pink Sheets. Bowser Report, BowserReport.com. Also the Bowser Warrant Register and the Bowser Directory of Small Stocks. The following brokers specialize in small stocks. American Western Seconds. Denver, CO. 800-525-1291. N Seconds. NYC. 800-221-7726. Blair & CU. NYC. 800-221-4333. Blinder, Robinson & Co. NYC. 800-525-2344. Chesley & Dunn. 208 Colorado Center. 1777 South Harrison St. Denver, Colorado 80210. 303-753-9930. Continental American. Grand Junction, CO. 800-528-0367. Lover & Co. SLC, UT. 800-453-3288. Dillon Seconds. Spokane, WA. 800-541-1563. First Colorado. Denver, CO. 800-525-3537. Russo Securities. Staten Island, New York. 800-451-7877. Interstate/Johnson. Savannah, GA. 800-929-0838. Torrey Pines. La Quinta, CA. 800-867-7390. Janney, Montgomery, Scott. Philadelphia, PA. 800-526-6397. Baron Chase. Boca Raton, FL. 800-937-4466. First Equities. SLC, UT. 800-453-9497. First Financial. Denver, CO. 800-525-6107. Hannafin, Imhoff. Wichita, KS. 800-525-2136. Johnson Bowles. SLC, UT. 800-453-4549. Kaufman, J. NYC. 800-221-7015. Larmer Sykes. Wichita, KS. 800-835-3105. Leonard & Co. Rollins, WY. 800-525-7497. McDonnell, Krieger & Bowyer. Denver, CO. 800-525-0303. Meyer, Pollock, Robbins, Inc. Melville, New York. 800-601-1151. MTN. Pacific Investment Co. NYC. 800-221-3525. Northridge. Ogden, UT. 800-453-3263. Lane Kemper. Portland, or 800-547-8575. Olson & Co. SLC, UT. 800-453-5321. Paulson. Portland, or 800-547-6710. Piper, Jaffray, and Hopwood. Sheridan, W.Y. 800-328-7488. Rooney, Pace. Great Neck, New York. 800-221-4138. Ross, Stebbins. Great Neck, New York. 800-221-8472. Securities Clearing. Las Vegas, NV. 800-525-3562. Sherwood. Denver, CO. 800-525-3449. Toluca Pacific. Bubank, CA. 800-284-8772. Townsend, Bowerl, and CO. Denver, CO. 800-525-9557. Universal Heritage Investments. 800-421-8861. Weller and CO. NYC. 800-526-1367. Wilson Davis. LV, NV. 800-453-5735. Wood Gundy. NYC. 800-221-4929. Penny Stock Websites. pennystockgroup.com. sec.gov/answers/penny.hdm. otcbb.com, OTC Bulletin Board where many penny stocks are traded. pennystocksweekly.com. value-stock.com, resource site for microcap, penny stocks. pennystockcollie.com. blog pennystocktips.com. pennystocktips.com. supernovastockpicks.com. pennystockpickcalert.com. signupstocks.com. pennystocksdaily.com. futuregems.com. pennystockcentral.com. 5dollarstocks.com, fee. affordablestock.com. allpennystocks.com. amazingpennystocks.com. pennyinvestor.com. pennymarkets.com. pennystock.com. pennystockinsider.com. penny-stock-picks.com. pennystocks.net. pennystocks.com. pennystocks.org. pennystocksdaily.com. Chapter 3. Investment Topics 3. Secondary stocks. Secondary stocks are simply small to mid-size companies. They're considered riskier than the blue chips because any changes in their status or in the economy as a whole has a more volatile effect on them simply because they're small companies. The trick is that if you pick a good upstart, you can easily double your investment every year. Standard & Poor has a mid-cap index made up of 400 stocks ranging in size from $200 million to $5 billion in market capitalization. If you do your research well, you can earn a lot more money by investing in secondary stocks rather than playing it safe with the big-time stables. Secondary stocks are generally more stable than the smaller, upstart OTC-type stocks because they have roots. They're all worth a substantial amount of money with a number of employees. Check for companies with strong cash flow, good management, valuable assets, and turnaround potential. Look for the growers. Some good ones are Apollo Group, Education, Equity Marketing, Specialty Merchandise, Metrotrans, Buses, Oakley, Sunglasses, On-Track Systems, Semiconductors, Safe Skin, Medical Gloves, Southern Energy Homes. Go to your library, find Forbes magazine in the stacks, look through them until you find the semi-regular feature called the Best Small Companies in America. Small cap stocks. Small cap stocks are considered risky because the companies are generally small, unproven companies without a track record, but if you use a good research service like a good small caps newsletter, they do all the work for you. Because small caps are so cheap, many people make a mistake and buy a lot of shares of only a few stocks. Whatever you do, diversify. They could up by a lot, but they also could go down too, so spread your money out into up to about 15 to 20 different stocks if you have that much. That's enough diversity. Even doubling a small cap stock still doesn't equal a fortune, but at least you're making money as any small time investor can. So invest in small caps, make some money, have some patience, and you will reap solid returns over time. The other big advantage to small cap stocks is that they're so small and so not bothered with by the big timers on Wall Street that many are virtually immune to daily and cyclic fluctuations in the stock market. The conventional wisdom is that small cap stocks are basically worthless, will not go up, and don't make much money if they do, but the truth is that most small caps are high energy, young companies that want to do something great. Some will fail. Most will reach some level of success. The fact is that small companies are the American dream and the foundation of America. Virtually every big company today was once a small cap. The reasons big brokerages do want to sell small cap stocks, or at least claim to not want to sell them, are as follows. 1. They are afraid, or claim to be afraid, that if they sell shares for company X and then it goes bankrupt, lawyers will come out of the woodwork to sue, claiming they hyped up this small cap stock in order to make money, then let it crash. 2. They claim that they are so big that selling small stocks and recommending them would cause the prices to soar, and they would be responsible for artificially inflating the price, but a bunch of insiders sold their shares off. 3. They claim they're simply too risky. 4. They claim that small stocks are fly-by-night companies started up to create hype, then sell out and run, the typical fly-by-night scam. 5. They have no past track record. In fact, many do. They operated privately for several years before going public. 6. It's not cool to sell small stocks. It makes you look like a peewee in a world of ego where brokers want to be seen as big timers. 7. There's prejudice against small caps. Most people who don't know anything about them heard some other bimbo say some cliched statement about them, so they mimic it like the one. It's priced like that for a reason. The truth is more likely that brokerages want to make money by getting accounts from people with money, and they don't want to bother opening accounts for average Joe with just a few $100 a month to spare for investments. Small cap stocks go up and down just like other stocks. Watch them for a while to see the trends. Time usually works for you. Stocks usually go up, but sometimes they go down. Stocks go up because the company execs are hungry and motivated, but then they make some money and some get greedy and lazy, so the stock takes a tumble. In order to find a broker who is willing to sell small cap stocks selling for $10 or less, check with the national discount brokerages, and also look in the yellow pages of your local phone book under financial services, brokerages, investments, or stocks and bond brokers. Call some local stock sellers up. Ask them if they're willing to sell small cap stocks under $10 and what their fees are. Think about a small company versus a big one. In general, they're young, new, and they try harder, especially if they have just recently gone public and started selling stock. They don't have the bureaucracies of big companies. They have potential to make great gains. They're not as arrogant as the managers of big companies who think they're big shot tycoons. Most are simply quietly trying to do a good job and get the company growing. On the other hand, there are risks too. Small companies can't afford to make too many mistakes. Their managers are often inexperienced, young people who can't get a good management job with the big guys, so they go to work for small companies. This could be a risk factor, inexperienced management. The big investors don't want to deal with them because they think that if they buy a lot of small cap stock X, they, as owners of a large amount of stock, will be tied into the value of the company, and they don't want that risk or responsibility. Overall, small caps are kinda of like small potatoes to the big institutional investors. They feel it's beneath their dignity as big timers to bother with them, but they're ideal for the average working man trying to put a bit of money away. You can't really listen to brokers or money experts. They're trying to make money off average investors like yourself. Mutual funds are risky because of all the expenses, plus the fact that the people managing your money are not necessarily smarter than anyone else, and you don't really know what their true agenda is. With small caps, just about anyone with a few bucks can enter the game. This is their big appeal and advantage. I generally don't believe in limit orders or having an automatic value with which to buy or sell, such as if the stock drops by 25% of what I paid for it I sell, but many people do and can even program their accounts this way, by placing limit orders. If a stock doubles, that's pretty good. It could be a good time to sell, but the problem with this logic is that if a stock doubles and is on a roll, it could double several times more. Don't be too quick to take the money and run. Watch a good stock and run with it as long as it runs. Good stocks tend to get better. Don't just bail after you make your first big score with a stock. Think of a Microsoft or a Dell, or in the small caps, Semtech or Smithfield Foods. The biggest mistake most people make beyond not diversifying regardless of whether it's a big or small stock is that they hold on to laggards with the hope that they will rise again. If you have a laggard, get rid of it. Cut your losses. Look for a good company selling a good product that doesn't have a lot of long-term debt which it will be stuck paying interest on for several years or more. Look at a graph to see its performance in the past year or so. As long as it's selling product, it should be in the red. Don't be too greedy and don't be too hasty in expecting quick results. It takes time for good companies to develop. Very few things turn to gold overnight. It takes a year or more. Nobody has a crystal ball. Even the smartest market watchers pick duds sometimes. By reading the Bowser report for small companies, I have found my share of companies that almost double in stock price per year, so this is where you can quietly make your fortune, with small companies growing quickly, but it's still puny compared to the big companies, which is why they get no mainstream press coverage, which is good for the investor because it thwarts the bandwagon effect. Look for the Bowser Microcap Stock Index in his newsletter made up of 50 low-priced stocks. Redchip.com. Smallcapstocks.net. Spin-offs. A business spin-off is creating a new business from your existing business. Apple went from computers to iPods. A local company went from making yogurt to making yogurt ice cream. A hairstylist starts selling his homemade shampoo. It could be in your field or something totally different. A computer maker gets into software. A movie maker doesn't have the technology he needs, so he creates it and spawns a business. He still makes movies but also makes a killing selling his special cameras. A big newspaper creates a smaller newspaper in a different area. A big company creates different companies for each of its major products. For stock investors, if you hear about a parent company forming a smaller spin-off company that goes public, that's usually good news. Whenever you hear about some activity with a corporation, investigate it more thoroughly. It frequently takes a year or so for the spin-off companies to really get going. Do your research by asking for filings from the seconds. Go to stock websites for info about current spin-offs. Spinoffadvisors.com. Spinoffprofiles.com, up-to-date research on spin-offs. Spinoffstocks.com. Stock search/old stock certificates. These companies will research your old stock certificates to see if they're worth any money. Fees.com/stock.hdm, collect old stock certificates. wasio.com, collect old stocks. RM. Smythe & Co. 26 Broadway. Number 271. NYC 10004. 212-943-1880. rm-smythe.com. Evaluates antique stock certificates to see if they're worth anything. StockCRChintl.com. 800-537-4523. This company will research your old stock certificates at $75 per company to see if they're worth any money. Stock splits. A stock split is generally done by a good company whose stock price is getting too high, so they merely do a split, like change one of their $90 valued stocks to two $45 stocks or maybe to three $30 stocks. These splits are usually announced in the media. There's no logical basis to the general rule that stock splits very often go back to their original levels within a year, so overall, they're a good deal if done with a good company, although some companies do it as a hyping measure to generate interest in their stocks. Look for companies that were split previously and the stock is rising. Look for stocks selling above $75 and smaller OTC companies looking to move into a larger exchange. Stocks that have split several times may be nearing the end of their run. Dailystocks.com, marketwatch.com/news/newsroom, splitpredict.com. Technical analysis of stocks and bonds. There are stock lists which are numerical ratings on a line and graphs or charts which plot the stock's performance on a graph over time. This is sometimes called technical analysis and can give you a good feel for the stock's performance in the past without having to read a bunch of reports to find it. However, it doesn't necessarily tell you where the company's going, so educate yourself about the company first. Technical analysis is one part, checking on the business end is the other. active-investor.com, livechits.com, stockcharts.com, tradesignals.com, technometrica.com, traders.com, tradingcharts.com, trainingforum.com, Babson United Co, babson.com. TV stock shows. There are good and bad in every bunch, but on TV, the so-called pros are mostly cheerleaders hyping up stocks they and their company have a personal interest in. Some of the guests and so-called analysts on the money shows sincerely want to do a good job, but in my opinion, if they're affiliated with any brokerage, they have a vested interest to hype the stocks that their company has a partnership with selling them. Even independent analysts could be hyping a stock they own to try to raise the value, which is less evil because they actually own the stock and must have some belief in it. In my opinion, there should be a law which states that any analyst giving stock advice in any media must state up front if he's got a connection/interest to that stock if he's rendering a positive opinion. Some of these guys come on acting so sincere, yet nobody knows that their company sponsored the IPO or they have invested millions in it. Myself personally, I disregard them all except for the PBS stock shows because they're a non-profit organization with a bit better karma than the commercial networks. Don't take anyone's words at face value. Look the stock over through some research websites before you buy it. Make sure it's not just a product of the hype then dump syndrome. Many commercial media shows are thinly disguised infomercials where there's supposedly an objective interviewer there whose guests are often CEOs, stockbrokers, etc. And unbeknownst to the general public, they pay the show a certain fee to get on and plug their product, but we think it's just an ordinary daily or weekly money show. The show itself has to earn money, and this is one way they do it. Value stocks info. Value stocks are inexpensive stocks of companies that are going through difficult times. Some are good, meaning the company will turn around. Some aren't. The company will go down further and possibly self-destruct. You can find gems in companies with very low Ps if they have good management and turn it around. IBM lost out from its mainframe business when PCs became popular, but new management moved in and they turned it around. Nortel Network went from about $60 to $5, then went down to 10 cents. ValueStockIndex.com, ValueInvestingNews.com, ValueLine.com, ValueStock.com, resource site for microcap, penny stocks. ValueStockBuyListProgram.com, ValueStockIndex.com. Volatility theory of investing. The volatility theory of investing is really quite simple. Granted, you want to invest in a good, solid company up front, but the truth is that many good companies fail not because of anything they do but because of the whims of the people playing the stock market, most of whom are sheeple who follow the emotional roller coaster sometimes called the bandwagon effect. This is the way the stock market is played: monkey see, monkey do. Everybody follows everybody else regardless of good sense, so the stock market is really dependent on the forces of the stock trader, not necessarily the good sense of the company trying to better itself. If a piece of hype about a steady company hits either way, it will create either an immediate sell-off, thus trashing stock prices for that company, or set up an immediate demand for that particular stock, thus inflating prices for the moment, even if only artificially so. Granted, in order to be a wise person, look for good companies to invest in, but more importantly look for the volatility of the stock. If it's going down, chances are it will continue to do so. Get out or don't buy. If it's going up, buy or hold, monitor it, then when you see it leveling off or going down, sell. Good stocks rarely go straight up. They pattern the stock market somewhat. They go up, then when the market fades, they go down a bit, so savvy investors focus on a few stocks like this, take the ride up, sell as soon as it starts dipping, wait until the dip is over and it starts going up again, then repeat the process. The bottom line is simply to watch the stock on the graph to see where it has been, where it's likely going, and take action based on that. The reasons behind upward and downward swings don't really matter. The reason is really always the same: the emotional mood of the investment crowd at any particular time. Your job is to understand this momentum the crowd creates and ride it or get out at the appropriate places. Warren Buffett and Berkshire Hathaway Inc. Anybody involved in the stock market eventually hears about Warren Buffett, the supposed prudent, Christian type, gentle, humanitarian man who made billions as a stock investor, and his prize stock called Berkshire Hathaway. Berkshire Hathaway originally started in 1889 as a textile manufacturer. Warren Buffett got involved as the CEO in 1967 at the age of 34 and transformed it into a diversified conglomerate whose business is to find great companies, buy them, then manage them to keep them great and profitable. Berkshire Hathaway is a large corporation which owns a number of smaller companies. They have certain standards they abide by before buying companies. They have a reputation as a stellar group of companies with stellar management. Everybody laughed at Warren Buffett for not getting on the internet stock bandwagon in the late 1990s, but he stayed true to his values and came out on top. In a statement to shareholders, he said, "We have embraced the 21st century by entering such cutting-edge industries as brick, carpet, insulation, and paint. Try to control your excitement." Berkshire Hathaway holds many different businesses but stays clear of technology, telephone, or internet firms. Buffett says that if the type of business doesn't have a track record over 10 years, he won't touch it. The Berkshire Hathaway stock is quite expensive for one share, but there are mutual funds that invest in Berkshire Hathaway shares, such as the AIC group of funds. Berkshire Hathaway Class A shares trade on the New York Stock Exchange for around $76,000 at the time of this writing. The more affordable Class B shares, the Baby Berkshires, sell at 1/30th of the price. Berkshire Hathaway hardly has any overhead expenses. That's the nature of the companies, no bureaucrats doing nothing much. Buffett appoints directors of Berkshire Hathaway by going through his list of people who have bought millions of dollars worth of company stock on their own. The pay is low and they don't even carry liability insurance on the directors as most boards do. For your information, I thought I would list the companies that currently make up Berkshire Hathaway, but this list is always changing as they acquire and sell companies. Berkshire Hathaway Inc. 3555 Farnham St. Suite 1440. Omaha, Nebraska 68131, 3302. 402-346-1400. BerkshireHathaway.com. Acme Brick. American Tile Supply. Featherlight. Glass Block Grid System. Texas Quarries. AcmeBuildingBrands.com. Benbridge Jewelers. Benbridge.com. Benjamin Moore. BenjaminMoore.com. BH Home State Insurance. Brookwood. Continental Divide. Cornhusker. Cypress. Gateway Underwriters. Oak River. Redwood. BH-HC.com. Berkshire Reinsurance Division. BreakDirect.com. Blue Chip Stamps. Court Furniture, CORT1.com. Kansas Bankers Surety. MS Property. Precision Steel, PrecisionSteel.com. Wesco Financial. Wesco Financial Insurance. Borsheim's Fine Jewelry. BorsheIMS.com. Buffalo News. BuffNews.com. Central States Indemnity. CSI-OMAHA.com. Dexter Shoe. Pan Am Shoe. dextersho.com. Executive Jet. Executive Jet Management. Executive Jet Sales. NetJets. NetJets Europe. NetJets Middle East. NetJets.com. Feckheimer Brothers. All Built. Nick Bloom. Brickerminkala. Command. Eagle. Farriers. Feckheimer Band. Flying Cross. Griffey. H. Harris. Harrison. Kale. K. Martin. McCain. Metro. Nationwide. Pirna. Robert S. Silver State. Simons. West Virginia. Zuckerbergs. FECHheimer.com. Flight Safety International. Flight Safety Boeing. Marine Safety. Instructional Systems. Simulation Systems. Visual Simulation. Flight Safety Services. Learning Centers. Training Academies. FlightSafety.com. Geico. Geico Capital. Geico Casualty. Geico Financial Services. Geico Indemnity. Geico General. Insurance Counselors Inc. International Insurance Underwriters. Safe Driver Motor Club. Geico.com. General Re. Faraday. General Cologne Re. General Cologne Life Re. Genre Securities. General Star Genesis. Herbert Clough. New England Asset Management. U.S. Aviation Underwriters. Genre.com. Hellsberg Diamonds. Hellsberg.com. H.H. Brown Shoe. Carolina Shoe. Cove Shoe. Double H Boot. Isabella Shoe. Lowell Shoe. Super Shoe Stores. hhbrown.com. International Dairy Queen. Dairy Queen. Orange Julius. Caramel Corn Shops. dairyqueen.com. Johns Manville Corp. jm.com. Jordan's Furniture. jordansfurniture.com. Justin Brands. justinboots.com. Chippewa Boot. chippewaboots.com. Nakona Boot. nakona.com. Tony Lama Boot. tonylama.com. Mid-America Energy. midamerican.com. Northern Electric and Gas. northernelectric.co.uk. Kalenergy. kalenergy.com. MyTech. National Indemnity Group. Berkshire Hathaway Life Insurance Company of Nebraska. Columbia Insurance Company. National Fire and Marine Insurance Company. National Indemnity Company. National Indemnity Company of Mid-America. National Indemnity Company of the South. National Liability and Fire Insurance Company. Northern States Agency Inc. Pacific Gateway Insurance Agency. Ringwalt and Lias BCO. Wesco Financial Insurance. NationalIndemnity.com. Nebraska Furniture Mart. Floors Inc. Homemakers Furniture. NFM.com. RC. Willie Home Furnishings. RCWillie.com. Scott Fetzer Companies. Autolat, ADLT.com. Campbell Hausfeld, CHPower.com. Carefree of Colorado, dg.com/carefree. Cleveland Wood Products, CWP-SFZ.com. Douglas/Quickut, Jinsu, QuickUT.com. France, Transformer.com. Halex, HAlexco.com. Kingston, KingstonTimer.com. Kirby Vacuum, Kirby.com. Miriam Instrument, Miriam.com. Northland, Northlandmotor.com. Power Winch. Scott Laboratories, ScottLabs.com. Scott Care, ScottCare.com. Stahl, Stahl.cc. United Consumer Financial Service. Wayne Combustion, WayneCombustion.com. Wayne Water Systems, WaynePumps.com. Western Enterprises, westernenterprises.com. Western Plastics, wplastics.com. World Book Encyclopedia, worldbook.com. See's Candies, seas.com. Shaw Industries, shawinc.com. Star Furniture, starfurniture.com. United States Liability, usli.com. Wrap Accounts Info. A wrap account is an all-inclusive account that covers everything: stock trades, mutual funds, annuities, bonds, account administration, etc. It's for investors who want a professionally managed diversified portfolio. Someone will advise you where to put your money, what percentage in stocks, mutual funds, etc. You will have a checking account and can manage your 401k or KIA through it. In some wrap accounts, a money manager or several money managers may have a program or several different programs where they pick their favorite investments and pool all the money they get into that program. Wrap account / hire someone to make trades with your money. A wrap account is a customized account where one or more professional money managers design an investment portfolio for you or an investing institution like a retirement fund based on what kind of security and profits you or they are looking for. Then they control it on behalf of you or the institution. Large financial services companies like banks, brokerage companies, investment dealers, and mutual fund companies offer wrap accounts. A wrap account can be made up of stocks, bonds, mutual funds, or other securities. You give the account manager the authority to buy or sell securities on your behalf as long as the trades conform to your investment strategy. You're hiring a professional account manager to try to make money with your money by buying and selling stocks, bonds, funds, etc. You tell this guy what you want him to do, whether to be aggressive, conservative, etc. The fees the investment manager charges for a wrap account may be tax deductible. Consult a tax advisor to find out. You can log into your account anytime and see what trades your account manager has been making. You can include or exclude certain stocks you don't like or really like. You can order the account manager to stay out of mutual funds, energy stocks, bonds, etc. You can sell any of the securities anytime you want to get cash. There are several problems with wrap accounts. There are high fees. The fees are usually 1 to 3% of assets under management / AUM. You need lots of money just to start the account, like $50,000 or more. Wrap accounts are like mutual funds in the sense that there are many different kinds, some focused or specializing in one area like energy sector, aggressive IT stocks, global equity, blue chip stocks or bonds. A program could be made up of 10 mutual funds, so instead of investing in one mutual fund, you're investing in 10. If you decide to start a wrap account and invest in it, you pay a flat fee to the money manager at about 3% per year, and whatever gains the program makes, you make that gain too. Many banks, brokerages, and financial corporations have wrap accounts. Ask if they have a wrap program, mutual fund wrap program, or a packaged wrap program. My advice is that investing money is not rocket science. Get an account with a discount brokerage like Ameritrade, then go to the library, to the magazine shelves, get all the past year's copies of Money Magazine and pick some stocks, ETFs, ADRs, and funds from what they say there.